All right. Welcome everybody to Midas Investing Live. Been a few weeks. Hope you all didn't miss me too much. Definitely been very busy. Uh, both in my personal and professional life, but also getting some stuff, ready for you guys behind the scenes. Not doing nothing, not sitting on my hands entirely, but hopefully I'll have a nice slate of content coming you guys' way, not just today's stream. But I did actually only 45 minutes before dropping this put out a new video. So of course not right now. We are in the middle of the live stream. You should definitely stick around for the live stream. But after the live stream, you should go and check out the video I put out on my pricing analysis process, or relative valuation as it's often called. It's kind of a first run in a new series that I'll essentially be doing. My plan is to essentially put out pricing analyses videos every quarter after quarterly earnings season comes to a close. Obviously, this one is coming like 3 weeks later than I would otherwise like to put them out at the end of the earnings season. So it'll hopefully be on time more regularly, which should be easier now that I've kind of got the process all lined up. And it's actually not just one video per quarter. I'll probably be putting out 2 videos per quarter, because the first one is focused on the S&P 500, whereas I will also be putting out videos on small cap indices as well. So I have essentially the analysis ready to go for the small cap indices, and I'll probably be putting that out in about a week. And also I have another video planned to come a week later after that, which will be a overview of the returns of all of the stocks that I have done videos for on the channel. So all of the ones here I'm scrolling past right now, going all the way back to when I first started doing the new style of video surrounding my DCF templates with the distributions of outcomes and the full revenue models. So we're going to be taking a look and seeing how good has all of my analysis been on all the stocks. The ones that I said were overvalued, how have they performed? The ones I said were undervalued, how have they performed? And taking also into account which ones did I buy, sell, or hold through those periods, and how does that even compare as well. So that'll be fun. Like I said, that video should probably be coming out in 2 weeks, since next week's will be on the small cap. So definitely be taking a look out for those videos. And then obviously doing the pricing analysis process, for anybody who's been around the channel long enough should know that that is actually kind of a precursor step in my evaluation process. I like to do the pricing analysis in order to sort of sift through and find opportunities, and then I move through the ones that look attractive to me on that basis to determine which ones I think have the most exciting growth prospects as an industry. And then I also then move from that point on to try to find ones that are actually good valuations, and then perhaps build models from those. So ideally, with that analysis done, I'll be able to actually get some great videos on some actual companies coming in the near future, which is worth noting. Like, for example, the last 3 videos, evaluation videos I did of Silvercorp, Hydrogen Struggles, and Mosaic, all 3 of those came out of successful pricing analysis that I did around December timeframe. So the point is I found it to be pretty fruitful the last time I did it, which is why I decided that I was going to make this a regular part of my process every single earnings season. So keep an eye out for all of that content. My school semester is coming to a close here at the end of the month, and this last week, for those of you who are in the Discord, probably would have already heard from me that it was essentially a very difficult crunch week for me. A lot of assignments that I had coming due essentially this next week, and then I also had some plans this weekend that made it so that essentially I had to do a whole lot of work this week. But the good news is I got all of it done. We're way less stressed out now, and that's one of the reasons that I was able to then focus and get some content out for you guys today, both the video, and then obviously we're doing the live stream right here, right now. So one other thing I want to say right before we get started talking about everything else, I'll say if you're just coming into the stream, whether you're new to the channel or otherwise, please like the video. It'd be really appreciated. I see somebody already went and liked it. I very much appreciate that. If you're not already subscribed to the channel, please subscribe to the channel. Make sure you hit the notification bell, all of that. Make sure that you get notified whenever I put out all the content that I was just talking about in the near future. And if you have not already, there's also the link that's the pinned comment in the chat. It's also in the description below to the free Discord. Please join the free Discord, be part of the community that we have going on there. That way you can hear about what's going on in my personal life when I'm not putting content out and why I'm not putting content out. But also when I'm not too busy, we can also talk about a variety of other things as we do in the Discord, or you can chat with other members there as well. We talk about what's going on in our own portfolios, what's going on in the markets, what's going on in actions of major investors, dropping some random memes here and there, analysis of various companies and things like that. So be part of the discussion there. Free to join. All right, last but not least, as we kind of get started, the kind of early pieces of the stream, I also want to spend a moment to shill for the channel a little bit. It would be really appreciated if you find any value in the valuation videos that I do or any of the content that I provide. It would be super appreciated if you could donate to the channel. There is PayPal links in the description below for which you can donate to the channel. It'd be really, really appreciated. Any amount is welcome, as well as if you do become a person that donates to the channel, we do actually have a special little channel on the Discord that you can join, where you can get essentially preview access or even exclusive access to some of the content that I'm making. For example, the analysis video that I just put out today, I did drop some of the results of that into that channel about a week ago. So the people who are donators to the channel were able to essentially get a sneak preview of what type of content is coming their way. And then if you don't want to use PayPal or do a one-time donation, there is also the Patreon link that you can find below as well. It'd be really, really appreciated if you could consider joining that. You could join at a lower tier just for the sake of supporting, or you could join at the $5 per month tier to get access to the valuation dashboard, which is the dashboard that you see on my live streams here on the Pretty Regular, where it has all the companies that I've done videos for, done full revenue models for, as well as a few others that I haven't even put videos out on. I just completed full models for that you can get access to. You can see where the valuations stand today, because I do often upgrade or downgrade valuations that I did after videos that I've made, not to mention a variety of other market statistics, as well as various details of analysis from analysts, as well as the results of the pricing analyses that I've done, which I actually still need to update with the new numbers. It also includes the ability to look up all the financials, 10 years worth of them for all of those valuations that I did. And then that also gets you access to the summary DCF information, including key assumptions like revenue growth assumptions, margin assumptions, capital expenditure assumptions, and all of that, including the summary distributions of value that I create in the expected return distributions. So if you would like to have access to all of that information, essentially pretty good summaries of all of the research that I do, kept up to date as best as I can, $5 a month is all it costs. Consider joining the Patreon, or like I said, also donating perhaps through the PayPal link. It'd be very, very, very much appreciated. All right, enough shilling for me. We can maybe move on to some actual content there. Brady, hey, see you there in the chat. Welcome. Thank you for joining us today. One other thing that I wanted to kind of comment on, since it is kind of a special occasion going on this here week, which is in the thumbnail for people who are looking pretty closely, but there is also a total solar eclipse happening on Monday. I kind of wanted to call that out because I myself am actually going to be going to see it. Part of the reason I put it in the thumbnail, but it is also just kind of a timely little joke I put there about inflation, which we're definitely going to be talking about inflation here shortly. But I myself am going to be traveling to Texas, well over 1,000 miles of a drive just for a 5-minute event. And let me tell you, as somebody who has seen a total solar eclipse once before, the last one in 2017, I gotta tell you, it is worth it. It is absolutely worth it. So if you are in any way possible to travel to the path of totality, which is this red line here in the middle, the deep red kind of band there, I would super recommend it. It may seem like a long drive for depending on where you happen to be, but it is super worth it. On average, about a once in a 10-year kind of event, although I think I read online that the next one's not until 2044, so it's actually more like 20 years until the next one. So you should definitely highly consider going, even if it seems a little bit out of your way. Obviously it's a little bit last minute to plan for it now, but you can still do so possibly. Just wanted to definitely throw that out there for anybody who is maybe on the fence about it or hasn't even realized that that was something that was happening, but definitely consider doing that because it's really, really cool. All right, so now we can go in and we can take a look at the portfolio. not too much going on in it at the moment. We haven't necessarily done a whole lot in the last few weeks other than just buy a little bit more of a few things that we've kind of already been buying. I bought a little bit more Mastercraft. I bought a little bit of some more Hydrogen and Struggles. Oh, here, hold on just one moment. My cat wants to get out of the room. Sorry about that. I'll let that cat out of the room so she doesn't meow the whole time. Anyway, as I was saying, bought a little bit more Mastercraft, a little bit more Hydric and Struggles. I also bought a little bit more INMD in the last couple weeks. I probably also bought a little bit more Mosaic since the last time we met. Not this last week, but probably like 2 or 3 weeks ago I did. So yeah, those are kind of the only purchases I've really made recently. Nothing new added to the portfolio in the time frame. As I said, mostly been focusing on those pricing analysis, which will hopefully uncover some new opportunities for us to look at. So we'll have to think about that as they start to come through. Also did trim a little bit more Smith & Wesson. As I initially said, I only trimmed up to a certain point on that one when it had made its original pop, and I was kind of planning to maybe make some further trims depending on how the price action moves. So I did do that a little bit as well. But beyond that, the portfolio has just kind of been sitting and chilling, other than rolling over our usual option strategy and changing over our index allocation depending on what our momentum signal says, which we currently are sitting in a neutral momentum, which means we have a relatively low level compared to the levels we could go up to for that. What we do is we alternate between how much cash we hold and how much index we hold. So we currently have about 10 to 11% cash, which is a relatively high amount of cash because we're in neutral mode. If we shift into bullish mode, we essentially drain out the cash levels into the index level itself, which in general, I would definitely like to get the index level lower, but that's entirely contingent on how many positions I can find of good valuation, because each of our position sizes are independent of each other and are relatively moderate. I try to keep things at a relatively small allocation size for diversification reasons. So the point is if I don't have a whole lot of undervalued individual stocks that I'm buying, well, that means that at the end of the day, once I net out whatever my desired cash level is, I end up just putting the rest of my money into the index. So currently I have much more of the S&P 500 index than I would like to hold at any given moment. But at the same time, the point is I have to like the securities that I'm holding. In terms of our option strategy, I did kind of want to comment on that. We've obviously seen some turbulence in the markets for the last week or 2 weeks or so. And so we're actually doing pretty good on the option strategy lately. In general is more of a continuous drag on our portfolio because they are deep out of the money puts as a hedging strategy. It's meant to tail hedge really, really large market drops in a relatively short period of time. But even with the market kind of just moving back and forth a little bit near its all-time highs, we're actually doing pretty good on the option strategy regardless of that, which is pretty good. That comes down to just improving our timing in terms of when we buy and sell out of those positions. But many of our positions have been doing pretty good just in general. FG obviously has been a killer for a long time. Meta's obviously been a killer for a long time. Smith & Wesson finally showed great returns somewhat more recently. FNF also for a long time. Although I did also identify a little bit of an issue with the way my total return calculation was working for FNF. It should not actually be over 100%. I think it should be more like around 60-70%, but there was an issue with the way it's calculating the dividends as part of it, because I use an adjusted dividend measure for when I calculate my total returns here based off of how much buying and selling of any of the individual securities I had. So I know that there's actually an issue right there that I identified recently. So something I'm probably gonna have to look at this week and try to fix. But that's not something that affects pretty much any of the other bars on this chart right here. Generac also doing pretty good, up now over 32% on our Generac position, which, I mean, on one hand, that's really great. I'm happy to be up 32% on Generac. But on the other hand, I was eyeing it when I was only up about 10% on Generac only a week or two ago and trying to decide if I should buy into some more Generac. But I was being too cautious, a little extra cautious, considering it is one of our larger positions. But I do have a pretty large amount of bullishness surrounding my Generac position. I do think that the long-term growth thesis for them is very strong. And I do also like a lot of the macro dynamics that kind of exist around them, particularly around power grid failures, that I personally think There's a very strong thesis for why power grid failures are going to become a much more common thing, especially considering how much juice is being taken out of the power grid from the electric vehicle revolution, and that's something that I think is going to heavily impede electric vehicles as well. But the point is Generac is kind of my play on that thesis, the assumption that essentially the power grid is too old, is not getting the maintenance it needs, and it is being taxed harder and harder with new types of technologies. And so Generac is a perfect company to play on that thesis. And unfortunately, the market decided to rebound on that stock pretty hard in the last week or two before I managed to buy a little bit more of it. So we're still only at about 5% of it, which still makes them our fourth largest individual stock position. But I kind of wish I had just sucked it up and bought a little bit more up on that one 2 weeks ago. But nonetheless, it is what it is. It might retrace back down, as it does tend to be a pretty volatile stock. Also been paying close attention to Click Digital, which is one of our smallest positions and definitely one of our most speculative positions that we have in the portfolio. I did talk quite a bit about that one in a few other live streams a month or two ago. And it is currently close to 20% down, like 15-16% down. And I think it was at like 18 or 19% at one point during this week. And I was definitely eyeing it and trying to decide whether or not I wanted to increase the position once I was 20% down on it. But considering how speculative it is, I am trying not to average down on it until I'm significantly down on it. So 20%, maybe 30%. The point is, I do see it having very, very volatile potential. It could potentially spike down pretty hard, though that wouldn't necessarily affect my thesis surrounding why I think it's going to do good, potentially in the mid to longer term. So either way, the point is I'm just trying to be careful about averaging down on it, not that I'm actually concerned about being down on it in general. But the point is I still haven't averaged down on it, but I've been eyeing that one, trying to decide when would maybe be the right moment to do so. Part of the reason I'm trying to be especially careful with the averaging down on that one is not just because it's speculative, but also because it is a foreign holding. And unlike some other foreign holdings with that one, I was only able to get into that one with certain commissions on the purchases as well. So I did pay some fees in taking on that position, and I would have to take on more fees in order to average down on it. So it's one of those positions where, because of that, I'm trying to be extra careful with it, since it has extra costs associated with it relative to some other positions. Not terrible fees, but fees nonetheless, really grinds my gears. So that's just is what it is. Also definitely been paying close attention to the precious metals in our portfolio. Obviously, my last live show, like over 3 weeks ago, I talked pretty significantly about precious metals, gold in particular. We did a large overview of the gold markets and how it works. But our gold plays have been doing pretty good. New Gold, one of the ones that we bought several months ago, is up 35% total returns. It's pretty outstanding. And Silver Corp, which was a silver play that was transitioning into a gold play, is up 55-56% in total returns, which is pretty outstanding. Though there is some news to be discussed about that, which we'll definitely be getting to shortly. Long story short, I'll give you kind of the spoiler alert on there, is that they're not going to be an actual gold play, at least not currently with the current plans. Their acquisition they had planned has actually been canceled. So like I said, we'll get to that in a little bit. I'll pull up some stuff to talk about there. Inter4 also kind of going back and forth. It pulled back pretty significantly after it had retraced back up pretty decently. There has been a lot of concerns about when interest rates are going to drop back down, and this is a company that is heavily dependent on needing the interest rates to come down in order for its value to be realized at some point in the future. The lumber is a very, very interest rate sensitive industry, so that's one of the reasons it's performed so poorly over the time that I've had it. We've definitely had that one for quite some time, about a year and a half in weighted terms, which is pretty disappointing considering it's down 32%, and a lot of people probably would have given up on it long before it got to this point, or long before holding it for this long. But I'm usually pretty patient about holding things, even if I've held them for a long time, they don't seem to be doing well. Another good example of that would be, for example, Barrick Gold, which is actually one of my oldest, longest held positions. And I was down on that pretty significantly for some time. And with the rebound in gold, I'm actually now basically about even on them in total return terms. I am still down on them in capital appreciation terms, but I have held them for so long that I've actually accumulated quite a lot of dividends from them over the years. And so we're actually about even on them if you include dividends. So that is where we currently stand on that one. But the point is gold is finally starting to make the moves that we've expected it to do for quite some time. I have been analyzing gold for many years, and so it's something that I feel pretty comfortable just kind of wading through the fog and wading through the swamp, so to speak, waiting for the other end of it to come, the light to actually show up. So point is gold is continuing to do its thing. In fact, if I was to come over here when we were talking about it only a few weeks ago, it was kind of hovering around the $2,200 an ounce mark, and it's already now up to 2,300 plus. So it's kind of made another little extra leg upward in its upward trajectory, which is pretty outstanding. At this point, it's pretty much parabolic. So would surprise me if we actually got a little bit of a pullback on gold at some point, or possibly even just a leveling off for some period of time, because it definitely is starting to get real frothy in terms of how big the move has been up and how fast the move has been up. Just looking at like the monthly candles, for example, are pretty bright and thick comparative to even some of the other previous leg up periods. But nonetheless, a lot of the bullish people in the gold market, a lot of the bullish analysts do tend to expect, and this was something that they had said when it was still trading under $2,000 an ounce, most people believed that when interest rates dropped, or when the next phase of monetization of debt began with the governments, that there would eventually be a leg up to $2,400-$2,500 an ounce. So the fact that we're essentially zooming up towards that point is not really that surprising, because that's pretty much what a lot of people were expecting out of it. There's lots of other people that even think that it could even go more towards like $3,000 an ounce, which wouldn't really surprise me. And gold is very much a long-term thesis for me, so it's not something that I have some quick desire to necessarily get out of, at least in terms of the actual metal, because I do hold a gold ETF in my portfolio, and so that's something that is more of a longer term hold. As far as individual miners, it kind of comes down to the valuation. Everything comes down to valuation with individual companies. So ideally, the point is to try to find things that are so undervalued that even as gold spikes up, it still stays within a reasonable valuation range. And with gold holdings, I'm not likely to sell unless I find them to be significantly overvalued, depending on the levels of risk associated with them. So that's kind of my feelings on all of the positions in our portfolio. We do have a lot of these green bars here on the total returns chart that I have right here, which I only put things colored green if I'm up more than 25% on a position. So that's the point where I consider it kind of significant returns. You know, the point where it's more than just kind of nominal returns because of market volatility. It's like once something's up over 25% from my average buying price, that's where I would say it's like, yeah, okay, that was actually a really good bet. That's something where you actually made a good move on that one. And likewise on the downside, 25% or more on the downside, that's where I recognize, okay, where we've definitely made some mistakes there, and at least in terms of timing and all that. Looking at our returns year to date, we are closing the gap a little bit with the S&P 500. Not tremendously so. They're still ahead of us. The S&P 500 currently is at like 9.5% returns on the year, and we're at like 4 and change. So, about 4 to 5% difference, when there was a point there where we were more like 7 to 8% difference. So we are potentially starting to catch up with the S&P 500, and we definitely overtook the small cap index again finally, which is nice because we were also underperforming them for a little period there too, which was especially embarrassing. It's one thing to be underperforming the S&P 500, but it's embarrassing in my opinion, at least for me, to be underperforming the small cap index. If we look at the total returns between all three of those indexes, I've been outperforming the small cap index basically my entire time investing, as you can see right here, by a pretty significant margin. The S&P, not so much. I've had periods where I caught up the S&P, and I've had periods where I've dragged below the S&P. We're still significantly below the S&P right now, but the small cap index, I basically always outperform. So to be underperforming it even over a 4 to 5 month period, it starts to feel a little bit embarrassing. So nice that we managed to at least outpace that one in the short to midterm. So let's see, we can come over to the valuation dashboard and take a look and see if there's anything of note to really comment on, which, to be honest, there isn't really that much necessarily to comment on, other than like Silvercorp, for example, has definitely started to draw back down. It's currently hovering around where my fair value currently is for the company. But there's some big caveats to that, because this valuation is still based off of largely the model that I built and described in the video that I put out on them, though I have adjusted some of the kind of other parts of the valuation assumptions in there since I put the video out. But nonetheless, the model I made is still essentially the model I'm using for that. And the problem with that is that that model was built around the acquisition that they were planning. So unfortunately, that means at some point or another, I need to go in there and I need to kind of remodel them a bit with some different assumptions, which is something I'm planning to get around to doing this week. Because if we come over to the Silvercorp website, they have officially announced that they are no longer pursuing the takeover bid that they were doing for OreCorp, which was the gold exploration company that had made the exploration in Tanzania for the gold mines that they were looking to start operating there. There was another company that came in and bought up a significant portion of shares of that company and put in a different author on the company and essentially made it so that Silvercorp was going to have to pay higher prices in order to take over the company. And they just chose to, you know what, let's not engage in a bidding war. Let's just leave that one on the table, which on one hand, it's very disappointing. I was very excited by that particular opportunity because I like the idea of a short to midterm silver producer kind of shifting into a mid to long-term gold producer, because that actually fits very well with my theses and my perspective on precious metals. It's like I definitely think silver has some very, very short-term to mid-term outperformance potential relative to gold. But then in the long term, I'm much more interested in holding gold. So that's why like that was literally almost like a perfect dynamic for my particular views on precious metals. So it's a little disappointing, but nonetheless, I like companies to not go out and buy things unnecessarily. So, not paying too high of a price is always good. Scott, yo, watching the pricing, lots of names we know in the first quarter. And compared to like the last analysis I did, honestly, there's lots of the same companies still in there from the Q4. But then lots of companies we've kind of been paying attention to throughout the first quarter. As I kind of talk about in the video, hopefully the next one I'll be able to get out about 3 weeks sooner relative to the end of the quarter. The goal essentially is to put those videos out essentially once the last of my companies have reported, which with my current portfolio, the last one that reports is actually Smith & Wesson, I believe it was, and they reported, for example, on like March 15th. So you could assume that essentially 3 months later from that is when the next one would come out. So essentially the next pricing analysis videos should theoretically come out probably like June 15th or something around there, or maybe about a week after that, because June 15th would be when I would start doing the process, and so hopefully the videos would come out like a week later after that. Good old Humana, definitely still underpriced. So yeah, definitely still looking very solid on that one. And as you and I have talked privately about, maybe at some point here I'll finally break down and start doing some real analysis on that. Maybe I'll take a pricing based position on it if it manages to hit that 25th percentile, and then maybe I'll build a full model for it. Who knows? But I still kind of want to make a full model for Mastercraft. I'm still behind on that too, but finally started getting some content out now that all of my school stuff finally got cleared up, finally got all that stuff basically out of the way. So now I can finally work on all the content that I've been kind of working on behind the scenes here. So yeah. Yeah, I can open up some PayPal first. Of course. But yeah, so with Silvercorp, like I said, disappointing that they stopped pursuing that acquisition, but at the same time, I like companies that don't chase acquisitions at just any price as necessary. Their current mines are still incredibly efficient, incredibly high margin for silver mines in general, still an incredibly attractive valuation. Silver still has a very bullish outlook for the midterm, and they have all the cash that they were going to spend on that acquisition still available to them, because they were essentially going to be funding that entirely out of cash and debt issuance, mostly cash with only a little bit of debt issuance. So the point is that means they still have a gigantic cash balance in order to pursue some other acquisition opportunities, or to put some dividends out, because they were also going to be slowing down their dividend rate for the sake of pursuing that growth opportunity. So the point is Silvercorp is still, in my opinion, a very, very solid holding. Nonetheless, it's just no longer shifting towards that gold thesis that I was like, at least in the short term. Like I said, they might identify a better acquisition or a new acquisition at some point in the near future as well. And then also, as I was saying, in terms of thinking about the valuation I made for them, the valuation that I made was entirely based around that acquisition. So I will probably work this week to build a second spreadsheet model because I'm probably just going to hold two separate ones together, an acquisition one and a non-acquisition one. But I'll build a separate spreadsheet model, putting it as sort of an as-is evaluation to take into account just what is their current mines look like, what's going to be like through the depletion of their mines, and what type of value is that going to give them. And for that particular valuation, I'll probably be a little bit more generous to them because when I was putting together the other valuation, I was assuming that their margins were essentially going to come down pretty quickly in terms of that as a way to kind of take into account the extra costs of trying to operate the new mines. But if I think about them as just operating their Chinese mines through to depletion, you can essentially assume that the capital expenditures go down much more reasonably as they reach the end of the life cycle of the mines, because you don't need to put a whole lot of more effort into mines that are essentially coming to an end, other than just basic maintenance levels, which of course for mining, there's still capital expenditures, even if you're just trying to operate the mine in general. But the point is I can be a little bit more liberal in my margin assumptions for them if I'm using just a as is, no acquisition valuation. So maybe next live stream I'll be able to go over the results of that if I've come to some conclusion there. So other things to kind of mention on the dashboard, not too much necessarily. I have been keeping a pretty close eye on Skyworks as another one that I kind of want to add to. It is one of our smallest positions. Actually, it is our smallest individual stock position in our portfolio. And I have kind of been looking to add more for some time, but trying to be somewhat careful because I am a little bit wary of having too much Apple revenues exposure there. But nonetheless, it's trading below the 25th percentile right now. So it's something that I've been looking at and definitely considering at some point I should add some to. Some of the members of the Discord, Scott in particular, for example, who are often my chart guru, so to speak, because my less than expertise when it comes to technical analysis. A lot of people seem to be telling me that where it's currently at, or maybe around like 102, is perhaps a pretty good bottoming point. So I've kind of been eyeing that and maybe hoping that maybe it goes to like 103 or something like that, and then maybe I would add some more there. But honestly, I might just have to break down and add some to it because I am expecting to be adding a lot more fresh capital to my portfolio in the coming months as I start to exit school and go into my long-term career, which I have pretty much 100% locked down my career position. So the point is I have a good idea of how much money I'm going to be making over the next year at this point. And so when I kind of do the math with my expenses, and I can kind of do some math to figure out how much money am I expecting to invest over the next 12 months. And that means I'm going to be putting a lot of capital in. So with capital going in, unless I want it to stack up as cash, or end up just going into the S&P 500, which I have a little bit of an aversion to. And that means I need to start making some decisions on what I'm going to buy up on relative to my current appreciation levels. I can't really pay attention to how much I'm up on something. I need to just look at the valuation and say, nope, we need to buy some more of this. And so Skyworks is definitely one of those ones that I've been considering buying more of at some point in the near future. I have also ignored this one right here on the dashboard for quite some time. I didn't put a video out on Premiere, PINC, but I did do a full model for this one, so it did end up making its way into the dashboard right here. And while it's not a model I have the greatest of confidence in compared to some other ones, it's still a full model. So I still feel like I did pretty good work in terms of trying to figure out its revenues and its costs. And I think I was pretty reasonably conservative on that. And it's just been hovering here in very, very cheap territory, also below the 25th percentile. And it also was one of the companies that looked really, really great on pricing when I did the last round of analysis several months ago. And that's where I identified it from. So maybe I'll start a position with that one. And then as Scott says there in the chat, maybe I'm going to buy some Humana too, as I've kind of already commented on a little bit as well. So really, all these things near the top of the list are pretty good targets for things that I might buy some more of in the near future or start new positions on. And that sort of goes for the secondary page too, of the ones that don't have full models. That's basically true there too. Like Mastercraft, I said I've already been buying some of. Humana is right there near the top of the list on this particular page. And then I haven't bought a position in RGP, Resources Connection, partially because I liked Heidrick and Struggles way more than I liked Resources Connection. Resources Connection is much more of a general employment services consulting company, not focused on the executive search quite the same way that Heidrick and Struggles did. And I chose Heidrick and Struggles because I really liked the kind of macro dynamics surrounding that one. But the point is this one has still been screaming cheap for a long time. it's trading at the 5th percentile that I have on that valuation. Though it is a basic valuation, it doesn't have a full model. Nothing on this list has full models, except for New Gold. Technically, I did build a pretty robust model for New Gold, but I did never shift it over to the other group. So that is what it is. Was Pink the one that that got bought? What are you saying? Did Pink get bought? I don't think so, because they're still trading. I'm not sure. I'm not 100% sure what you're talking about. I'll have to maybe look into it, or maybe we'll talk about it at some point. Terminal multiple only 12 on Humana. Yeah, if you pay real close attention, next to the value that I have for a company and the upside I have and the expected CAGR I have, I do have the terminal multiple column here, which gives you an idea of how conservative I am being in terms of just the pricing dynamics of the stock, not just the fundamental projections I make on the company. But yeah, 12 and a half. It is healthcare, financial healthcare, and financial healthcares do tend to be, a little bit on the cheap side in terms of terminal multiples. Oh, Pink was a competitor to TH. Yeah, a little bit to a certain extent. I mean, Pink's also a competitor to Humana to a certain extent, at least for more of their like care services, not on the insurance side of things. But they're kind of in that category along with what's it called, Cencora, and what's another one? Healthcare supplies. They were a really cheap healthcare supplies for like hospital supplier kind of thing. Very low margin company. That's one of the reasons I haven't jumped into Pink. I'm pretty sure like the margins, the operating margins I have for them is probably like 3% or something like that. It's really low margin company, and that's one of the reasons I'm a little bit hesitant to jump into that one. Kind of the same reasons as I've talked with you. I'm trying to be careful and hesitant about Humana, but I do think Humana has a much more robust brand in general. So, and they're also a little bit more diversified because they have more of the insurance side of things as well. Yeah, med supply restocking. So yeah, they do a few things though. Pink definitely does a few things because they do some technology stuff with those supplies as well. Device supplying, not just kind of like the smaller scale supplies. But yeah, just another one of those healthcare ones, but not an amazing company, it seems to me, in terms of its brand, but it does seem really cheap. So it's one of the ones that, yeah, I've kind of ignored it here near the top of the list for a while. It's basically been in this spot since I put it here, and I've ignored it. But like I said, if I have enough fresh capital coming in, then that gives me a little bit more of an incentive to just say, you know what, let's diversify in small positions, add a couple more smaller positions. So maybe I could add a small position on that one, maybe add a small position on Humana, and maybe even consider adding a small position on Resources Connection. I could do stuff like that. Then, as I've talked about many times in the last, I don't even know how many months at this point, still staring at Meta here down at the bottom of the list, easily the most overvalued thing in my portfolio. And the choice to continue holding on to it has paid off, considering it's now currently at all-time highs as of the 3% it jumped on Friday. But at the same time, at some point or another, I'm going to have to cut it from the portfolio, and that might be coming soon. I know I've been saying that for a while, but it might happen soon. Is the terminal multiple on Mosaic low for its history? No, that's like pretty typical for its history. Well, for its history, taking into account interest rate changes, because keep in mind, like how I come up with these terminal multiples, I kind of have a little bit of a process for how I determine the terminal multiples I use. And to be honest, like I don't actually use a terminal multiple. I use discount rates and growth rates. But if you do the math with a discount rate and a growth rate, you can back yourself into a terminal multiple. And I like to share that information because a lot of people prefer to think about terminal multiples, since it's a little bit easier for people that aren't like familiar with finance math in the way that I am. So I like to display it as a multiple, even though technically I didn't actually use a multiple. But the methodology I use is I look at both their history over the last 10 years as well as their competitors' history over the last 10 years. And then I take averages of that, and then I adjust those averages for the interest rate changes that we've had from the average of the 10-year period to where we currently are and where I expect it to be over the next 10-year period. And so it's often kind of like an average, but with a little bit of a discount to that average. So I think Mosaic's average was like a 12 or a 13 for like the last 10 years or something like that. And so you see like an 11 and 12 here or something like that. So that's kind of like a rough example of how that sort of pans out. And like I said, that's basically the how I do it for all of them. And you can make your arguments about how that could be conservative in some ways, but I prefer to lean towards more conservative things, especially when it comes to terminal multiples, because terminal multiples are kind of like the part of the valuation that's like mean reversion. And so like if you're assuming that a company is going to mean revert back to a high multiple that it's had for the last 5 to 10 years, well, then you have to assume that its fundamentals are basically going to perform pretty much the same way as it did the last 5 to 10 years as well for that to make sense. Because otherwise, like I say you have a company that grew a lot the last 10 years and you assume that they're going to grow half as much in the next 10 years, well, then they probably don't deserve the same terminal multiple then. Because if they're going to grow half as much, growth rates go into terminal multiple calculations, and also so does the risk associated with those things. And so usually the terminal multiple comes down over time. So that's kind of why I use that approach. All right, so one other thing, we already talked about Silvercorp, which was one of the companies that had some news that I kind of wanted to talk on. Also wanted to talk about InMode a little bit. There was some news this week with the results of their shareholder meetings, that there was some changes going on at InMode, which I think is for the better. Might make some people happy. For some of the people who've been following the channel, some of you that have been invested in InMode longer than I have, and some of you have been invested in it since I invested in it. So it's definitely something I try to pay attention to. And obviously, I know this is a very contentious company in the group, in the Discord in particular. It's probably one of the most hotly debated topics that we've had for some time. We had some hotly debated topic of advanced auto parts at one point in time. We've had a hotly debated topic of Meta at one point in time. There's some companies are a little bit more contentious of a discussion amongst the members than others, and InMode has definitely been one of them. But the point is with a lot of the disappointment of the CEO's comments in regards to capital allocation over the last several months, as well as the slowdown in growth, not to mention the conflict in Israel and a lot of people's concerns about that. Yeah, as Scott says there, Ulta is another one. Yeah, definitely a hotly debated company as well. There's a handful of them. Some companies more people tend to agree on, and some companies other people tend to disagree on. But InMode has definitely been one of the ones, especially considering its poor performance, that people are questioning whether or not the assumptions I made make sense for the long term, and questioning whether or not the actions of the management make sense. And I've been kind of doing my best to defend it because I still believe pretty strongly in the thesis. But anyway, the news that did come out is that they have decided not to re-elect the current CEO, Mr. Moshe Mizrahi, as the chairman of the board. He is still the CEO. They didn't kick him out as CEO or anything like that. But the point is, it was previously a duality amongst the structure of the company, where they did have the CEO and the chairman as the same role, which is pretty common for a lot of companies. But to be honest, it's not actually a very smart choice to have the CEO and the chairman of the board be the same person. Because obviously that means that the CEO can vie much more for his own desires in terms of the shareholder decisions that are made at the board of directors level. For example, that applies to capital allocation, because quite a lot of the capital allocation decisions have to be put through to the board of directors. Specifically, for example, things like dividends and buyback authorizations, as well as final decisions when it comes to acquisitions and other things like that. Not to mention also there's things like compensation packages that are decided at the board of director levels, though there is also usually a separate committee that works on those things as well. But the point is Mr. Mizrahi has not been elected to be the chairman of the board for the next few years. Now, in the announcement, they did not announce who the new chairman of the board is, so hopefully there's going to be a follow-up announcement at some point where they make a decision on that. But the point is, I do think it's probably for the better. This sounds like a pretty good decision. It sounds like the shareholders decided to put their foot down and say, no, we don't think you're very shareholder friendly currently. And so we want to kind of separate out the role so that we can monitor your decisions a little bit more closely. Because that is what the board of directors' job is. It's like the board of directors is the representatives of the shareholders, and they hire the CEO to serve at the discretion of the board of directors for the sake of the shareholders. So That's why having the two positions together, while it can be useful in some regards for certain things, like for example, making decisions happen quicker and with less deliberation, it also means that if the CEO is not acting in the best interest of shareholders, like a lot of people seem to believe is currently the case, then they can kind of force the hand a little bit more effectively. So I'll be very curious and be keeping an eye out to see who the new chairman of the board is. They did choose to re-elect Michael Engel, which is like the chief medical officer to the board. So he's still going to be on the board, as well as Nadev Kenneth also is remaining on the board. So they did allow the other people who were up for re-election to essentially continue their positions. And then one other thing that they chose not to do in this particular proposal was they did not approve the updated compensation policy, as well as to approve and ratify the acceleration of the RSUs that were being vested for one of the other executives as well. So the shareholders not only put their foot down in terms of the chairman of the board position, but also those compensation decisions that were being put forward down here too. There's six things that they were voting on, and they only voted yes to half of them. And the ones that they said no to were specifically about about compensation packages and about the chairman of the board. So sounds to me like there is some things in motion in mode. You know, it sounds like we might see some slightly different decisions coming forward. The CEO in recent interviews, recent meetings that they had did announce that they were going to be doing likely going to be doing a dividend at some point in the future. They weren't very specific on what that meant, but I took it to mean that they were probably going to announce a special dividend at some point or another. I kind of highly doubt that they're going to move to a regular dividend policy. Though I would welcome that too. I just don't think it's likely. He said the CEO himself did say that they were planning for a special dividend at some point in the near future. And who knows, maybe it'll be a bit larger now, or maybe they will convince him to do a buyback authorization. Who knows? The point is now the likelihood of getting those type of capital allocation changes in place is now much more likely. So very good, very, very good. Yeah, thanks, Vanguard. in a non-sarcastic way. Thanks, Vanguard. Yeah, so we'll see what happens with that one. But yeah, he certainly could be well, you know, they can force a buyback authorization, but they can't necessarily force him to actually do the buyback. It kind of depends on how they arrange it. Technically, you can make some sort of automatic systems as well, but he'll still have power. You know, it's not like he won't have power. But the point is now he has less power, and if he continues to not do decisions that the new composition of the board likes, well then, you know, at some point or another, it's possible he could get kicked out as CEO. But I wouldn't actually like to see that, for the record. He is the founder of the company. I do think he's actually a great CEO, despite a lot of the negativity surrounding him right now. As I kind of commented in the Discord at one point or another, it's like I would much rather have a medical doctor heading a medical device manufacturing company rather than a finance major, you know. And I say that as a finance major. I'm a finance guy. I love finance. I'm the type of person that likes to think about discount rates and costs of capital and capital allocation and things like that. But to be honest, that's not what I want the CEO of this company to specialize in. So I'm perfectly okay with him maybe fumbling on some financial decision making, as long as he's not fumbling on the medical manufacturing decision making. That's kind of my opinion on him as a CEO. It's like I'm not actually worried about him as a CEO in any particular way, but perhaps if we want the board to be more focused on the finance people, that's fine too. So we can go with that. Yeah, it's like you really want people to specialize in whatever their products are as a CEO. That's what you want, you know, at least in my opinion. I would much rather have an expert in the product itself rather than an expert in business. So that's my kind of opinion there. All right, so let's move on to the topic that's in the thumbnail. I thought it was a pretty funny joke, both because I'm going to be going to see the eclipse on Monday, but also because I do think there's something to be talked about here in the discussion of inflation. So this is kind of like a composite measure, but let me flip over to the CPI measure gauge. Here we have the consumer price index on a 3-month impulse, 6-month impulse, year-over-year, and 10-year compound basis. So if you're looking for the year-over-year number, which is the reported headline number, that's the yellow line that we have right here, topping out at about 9% in June of 2022, and it's currently down to, what is it, about a little over 3%, 3.1, 3.2% on the year-over-year basis as of February. We're going to be getting the March numbers here this week on Wednesday, I believe it was. So we'll have to keep an eye out on that. In fact, wait a minute, I have the calendar up right here now that I remember. And the expected number is 0.3% on the month-over-month basis relative to the 0.4 that we had last month. And to kind of keep that in context, I can flip over to the actual month-over-month changes we have that I have right here. Again, the now this has all 4 of the different measures that I like to look at. So looking at the blue line, which is the CPI, is either 0.4% is what it had right here in the last month. But you can see, like, I also have it over the last 13 months. That's what this chart shows, is the last 13 months. And the reason why I do it that way is so that I can see the current month, but I can also see what that was in the previous month before that. So the point is like the 0.44% we had in February is a little bit higher than the 0.38% that we had a year in the same month a year ago prior to that. So essentially we replaced 0.38 with 0.44. Now, the reason why I point that out is that on this thing here, it seems to say that we're going to be getting a 0.3% is the expected number. So if we were to get a 0.3%, you would be replacing 0.08% with a 0.3%, which means that we would have the CPI starting to move upward in that move over the year-over-year move. Move my pick so I can see the timeline. Yeah, okay, hold on. Thanks for calling that out. I'll go ahead and do that. Head up here to the corner. Appreciate that. But yeah, so the point is you know, even looking at this, you can kind of see yeah, there's obviously zigs and zags when it comes to the month-over-month changes, and there often is a little bit of a seasonality to it too as well. There often tends to be slightly hotter numbers in the peak levels of the summer, and sometimes there's some hotter numbers in the peak months of winter as well, depending on the measures you look at. But one thing I kind of want to point out is that in general, on the 3 core measures here, because the green one is housing services isolated, so really kind of ignore the green one. It's kind of a beast of its own. But the 3 kind of core measures, which are numbers that both the markets and the Fed likes to look at, which is the red, yellow, and the blue lines, you can see that in the last few months, they're starting to kind of trail upward a little bit. They're starting to really trail upward a little bit, especially the services X housing one, as you can see right here, really had some hot numbers in the last couple of months or so. And that's something that we should definitely be a little bit concerned about. Coming over to the 3-month level on an average basis, this gets in my opinion, this is what the 3-month impulse is made of, but this is just looking at it as an average of 3 months, not an annualized number for it. And so like I said, we're expecting a 0.3% number. The 0.3% level is kind of like right here, and that's kind of basically in line with where it's been for the last 3 months on average, at least for the CPI and the core PCE numbers. So anyway, but I isolated each of those 3 measures into separate charts. So I have the CPI chart right here, the core PCI chart right here, and the CPI services less housing gauge right here. All 3 different measures that the Fed likes to look at, 3 different measures of inflation. And the thing I want to point out here is that if we look at the 3-month annualized, 6-month annualized, year over year, and then the 10-year compound as kind of like 4 different moving averages for each of these measures, you can see that we're actually starting to move into an upward momentum for all these measures. We really are starting to trend upward. On the consumer price index, the 3-month is higher than the 6-month, which is higher than the year over year, which is higher than the 10-year compound average. You can come over to the core PCE, same thing. We have the 3-month higher than the 6-month, higher than the year over year, higher than the 10-year average. Coming over to CPI services housing, this one's worse than the other 2. 3-month higher than the 6-month, higher than the year over year, higher than the 10-year average. And it's basically been that way for solidly the last 1 to 2 months. But it's been trending that way for more like the last 6 months. It's definitely been either leveling out, as you can see right here on the CPI gauge, or on the core PCE, we definitely dipped down hard, but then kind of bounded back up in the last like 3 to 4 months in terms of these annualized numbers. And then on the CPI services less housing, really we bottomed out close to the beginning of last year. You know, it's like we're like mid last year at best, you could say, and it's really been solidly trending upward ever since then. So I would be very concerned about inflation. I would definitely not be convinced that inflation's dead. I would not be complacent on this at all, especially considering where the markets currently stand on things. You know, one thing I should have actually brought up was the FedWatch tool. markets still expect the rates to stay the same at the next meeting, which is at the beginning of May. And that's important to keep in mind because, like I said, we're going to be getting inflation numbers here this week, but then we should also be getting core PCE numbers in like the third or maybe the beginning of the fourth week of the month. And so we'll have new numbers for all three of those gauges before the Fed meets again. And that's something to keep in mind. So even though I'm showing you these upward momentums on all three of these figures, it's possible that that could shift with new numbers for all three of these gauges over the course of the next 2 to 3 to 4 weeks. But the point is, at the end of the 4-week period, we are going to be having another Fed meeting on which date is it? The first of May. So actually, yeah, more like 3 weeks away. And at that meeting, it's expected that they're going to hold steady, but it's the next meeting that the market has basically been implying heavily that they're going to start doing their cuts, 25 basis points at a time. And the market seems to believe that they're going to skip a meeting in between, do another 25 basis points, skip a meeting in between, do another 25 basis points. And then that was going to equal the 3 cuts that have been expected by the market by the end of the year, by the December meeting. And then they would continue the process into the next year. But the point is it was going to be 3 cuts by the end of the year and then continue the process into next year. I'm bringing this up because I don't know, guys. It doesn't seem to me like that's necessarily a for sure foregone conclusion. And now, obviously, let's be clear. Just because inflation is doing this doesn't actually necessarily mean that they don't choose to cut back down. You could make arguments for why they would still cut anyway, even though inflation has been trending upward. Like maybe the Fed believes that this level right here is still too high, but maybe if they come down to 4.5%, they can just leave it at 4.5%, and then that would maybe be high enough that in the long run it would bring down inflation, but then it would maybe be a little bit easier for the market. So you could still make arguments for why they would still cut before inflation has continued to trend downward. But the point is, inflation is not still trending downward. And so if they do choose to cut, it means that they're moving counter to the expectations that they had laid out initially, which is that they would be for sure that we're trending downward to 2%. And then obviously they could be doing this somewhat for political reasons too, on multiple levels. A lot of people like to argue that the Fed wants to back one particular administration over another administration. I don't really technically like to make a big opinion on that one way or the other. But the point is some people like to believe that they really do want to cut things a little bit before the election cycle. Other people like to argue that they would actually bow out and not do the cuts until after the election, or maybe do one cut before the election and then pause until the election's over so that they don't seem political. And then this is the part of the political end that I personally do believe in, which has nothing to do with which party is currently in the White House. In my opinion, the political end that I focus on is more about the cooperation between the Treasury and the Federal Reserve. I don't really care so much about the White House and the Federal Reserve. I pay attention to the Treasury itself. And regardless of which party's in power, the Treasury has been putting massive deficits in place for the last several generations, or the last several decades in administrations. Basically, the last 25 years of administrations in our country have had irresponsible financial management ever since the Clinton administration. Technically, Bill Clinton was the last president to be halfway responsible when it comes to financial management. Not amazingly so, and still a Democrat, which are generally thought of as people who are a little bit more spendthrifts than the other side. Though, like I said, I would argue that both parties like to spend like there is no tomorrow. I don't particularly hold one as necessarily super worse than the other. It's just that different parties like to spend on different things, generally speaking. But the point is you could argue that they are being political in the sense that they want to make it easier for the Treasury to finance their deficits. And so one reason why they could potentially choose to cut rates, despite the fact that inflation is not back in the bottle, is that they want to make it so that the Treasury doesn't have a crisis and doesn't blow up. And then obviously that could lay into economic reasons as well. A lot of people are concerned about commercial real estate and the housing sector having slowed down as well. And the fact that those particular sectors of the economy are definitely in some serious pain right now. The rest of the economy has just been ignoring the rates full stop. And that's one of the reasons that we've had inflation last as well as we had. And it's also a good reason for why inflation is likely to perhaps continue, is that, to be honest, the US economy is actually just being a lot stronger than everyone expected it to, myself included. But the point is it's possible that we continue to have economic strength through the end of the year and into next year. But in my opinion, that means that it's for sure going to re-spark inflation. I'm the type of person that doesn't necessarily think inflation and economic growth is always tied together. I think they can run pretty independent of each other, and I tend to be pretty concerned about the idea of stagflation. But at the same time, you definitely can see high levels of inflation when the economy is going strong. And we have been going strong, and it seems in all likelihood currently like we're going to continue to be strong at least through till through to the, like the third or fourth quarter of this year at a minimum, if not through into next year as well. So I definitely think inflation is starting to trend back upward, and I think everyone should be very, very careful of that, because the stock market sure isn't acting like that's the case. The bottoming of the little pullback that we had at the end of last year, this rebound started to occur after the Federal Reserve started to make comments about the fact that they were going to cut rates. So while obviously a lot of the move from last year was responsible due to the AI hype, and you could argue a lot of the continued strength in the stock market has been due to AI hype, but also due to the general economic strength that we've seen in the U.S. economy, there also was the pullback that was then rebounded by the Federal Reserve's comments. There's like no doubt about that the bottoming literally timed with Fed President Waller's comments, so it's not a huge surprise there. But the point is it seems to me like it's very possible that the Fed, if they do choose to do their job correctly, won't actually cut rates. Or if they do, it might not happen until next year or something like that. So I don't know. We'll have to see about that. The Treasury has also started to rebound a little bit. Incidentally, it's funny because the Treasury kind of started to rebound not too long after those same comments. The comments came in October, so really the rates came down for that, but it was only a month and a half later that rates then started to rebound a little bit, despite the fact that the market continued to do well. But the point is, we are already halfway back up to where those peak levels were at around 4, 9, and 5% or so. We topped out at 5% for like a day or two. So the point is, this is on the 10-year rate, the 10-year rate in general. But if we zoom in, the moving averages are starting to cross over. So you could start to argue that we're back into strong bearish momentum when it comes to treasury prices. I say bearish because yields are inverse to treasury prices. So bullish on the yield momentum, but bearish on the actual treasury bond prices themselves. Then obviously in the last week with some of the negativity surrounding the Middle East conflict, we did see a nice spike in oil prices back up to some higher levels that haven't been seen since November of last year. Which, you know, we did bottom out pretty significantly in the upper 60s, but now things are starting to trend back upward. Moving averages also beginning to cross over. So something to pay attention to: oil prices, yields, and then, as I've also been talking about obviously for a while, gold prices. Gold prices bottomed at the same time that we were getting those comments from Fed President Waller, because lowering of interest rates generally implies upward movement in commodities, especially in monetary commodities that are essentially like competition to treasuries. So that's one of the reasons that gold was doing so well here. The interesting part is that even though the yields have started to trend back upward, and we've been getting some talk of potentially yields not coming down as quick as we expect, gold is still taking off. It's being completely unaffected by that fact, which I think is showing that there is potentially a breakdown in the inverse correlation between yields and gold that's starting to happen, partially possibly because I think maybe some members of the market are starting to believe that the Fed does not have it under control. Maybe they do believe that the Fed is getting a bit political in terms of treasury finance for its decision making, because if the Fed is going to lower interest rates just to help the treasury out, then that means that Chairman Powell is not Volcker. He's not Chairman Volcker, who is the person who tamed the inflation beast last time around. That means that instead he's Arthur Burns, who was the chairman that let inflation get out of control in the first place. So the point is be worried about a second bout of inflation, and hopefully you already own some precious metals, because it might be too late to buy some. So I'll make my comments on that one too. But in terms of the market, it's worth noting that if they do lower rates and inflation continues to be out of hand, it's possible the market will continue to be strong throughout that, because the market does tend to go up with inflation. It is a good inflation hedge, generally speaking, historically. It's only when government officials choose to try to bring inflation under control, that's when the market starts to freak out, right? Like the market did great during 21 and 20, 2020 and 2021, right? When inflation was getting out of control, the market did fantastic. It's only when they started trying to bring inflation under control is when the market started to go poorly. So the point is just because I'm talking about inflation getting out of control doesn't mean that the market is gonna freak out and go negative real quickly on that basis if it seems like the Fed isn't gonna do anything about it. It's only if the Fed seems like they're gonna do something about it that the market starts to freak out. It does mean bad stuff for the economy in the long run, but in the short to midterm, it can be pretty bullish for the market actually. So there you go. That's pretty much all my comments and all the stuff I wanted to talk about today. It's now been an hour and 5 minutes. We can talk about some tickers if there's people in the chat that wanna talk about some stuff. We can shift topics and go to maybe look at a couple companies perhaps. I don't know. Up to you guys. I believe Scott's probably still in the comment. He was talking somewhat recently, but nobody else has been talking too much today. So I don't know. But we could take a look at some companies maybe if people want to. I could pull up in the pricing analysis and we could start maybe looking at some of those top companies that were on it potentially. That could be something we could do. Let me pull that open. Obviously, the top ones on the list were CBRE in the real estate sector and NRG and utilities. I'm pretty sure I've kind of looked at both of these a little bit before previously, and I didn't really like either of them if I remember correctly. But let me double check on that. Let me be remembering poorly. There's so many tickers out there; it's hard to keep them straight sometimes. CBRE Group operates as a commercial real estate services and investment company, operates through 3 segments: advisory services, global workplace solutions, and real estate investment segments. So I would definitely be worried about those global workplace solutions since that's a lot of those office spaces, it sounds like. But advisory services and real estate investment segments, I'd be kind of curious what type of revenues they actually get from that. Is that like, like who are their customers? I'd be kind of curious on that front. I haven't looked at the company too closely, but you could maybe argue that those are potentially safer categories than the global workplace solutions category. Advisor services provide strategic advice and execution to owners, investors, and occupiers of real estate in connection with leasing of offices, industrial and retail space, property sales, and mortgage services under the CBRE Capital Markets brand. Property and project management services, including construction management. Well, that sounds pretty neat. Marketing, building engineering, lease administration, accounting, and financial services for owners of and in investors in office, industrial, and retail properties, and valuation services, including market value appraisals, litigation support, and discounted cash flow analysis, and feasibility studies, as well as consulting services such as property condition reports, hotel advisory, and environmental consulting. Yeah, see, I mean, that advisory services segment sounds pretty cool. I'm not gonna lie, like a lot of that sounds pretty good. Global Workplace Solutions segment offers facility management, project management, and transaction management services. Very, very quick and kind of vague, but maybe not as bad as I think it is. I don't know. The facilities management doesn't sound so great. Project management, it sounds maybe good. It depends on what they mean by that. I have to look in their financials on that. And then transaction management, that also sounds maybe not so great. Real estate investment segment and provides investment management services under the CBRE investment management brand to pension funds, insurance companies, sovereign wealth funds, foundations, endowments, and other institutional investors. That doesn't sound so half bad. So I don't know, maybe 2 out of 3 of these segments sound maybe like they're a little bit better than just the negative red flag commercial real estate sounds to most people these days. That could be kind of interesting on some categories there. Let's go take a look what their estimates are like. They're expecting 10% revenue growth this year, 9% next year, and 10 to 11% the year after that. That's a little bit better than catastrophic. That's definitely nothing that screams terrible. EBIT margins, very not impressive. These EBIT margins are definitely nothing to write home about. It's definitely not like a real estate investment trust type of operating margins, but they do a lot of advisory services like I was just showing there. So it's really a different type of business model than a lot of real estate necessarily seems to imply. maybe this is a company that doesn't necessarily overly fit into the real estate sector grouping. I did comment on my video that there's often a lot of weird outliers as far as like what gets included in what sector. This is a lot of real estate related services, so they included it there, but it doesn't necessarily compare to a lot of the real estate operators, perhaps. But like looking at their EBIT margins over the last 10 years, it looks like a nice solid downward trend, which is not so pretty to see. But maybe we would see a little bit of mean reversion back to the 5 to 6% range, possibly. I don't know. It's hard to say. I would be curious. Maybe the business model was shifting a lot over this time frame. That might be part of the reason it's changed the way it has. I'd have to look into that to get a good idea of exactly what's going on there. How does that compare with the gross margin, since they're advisory services? That might be something to look at. Gross margins have also been trending downward, so that's possibly part of the reason that they're getting the loss on the EBIT margin there. But so yeah, I can see why people would maybe be negative on it, but like I said, that's maybe not the worst of business models. Yeah, this asset turnover ratio is definitely not what you would normally see for a real estate company. This is definitely a much more robust type of asset turnover level. Why is it chart being so weird for me? But this is a good asset turnover, so that kind of counteracts the negative EBIT margins a bit. 1.5 would be a little bit better, perhaps, if you're going to have like a below level of single digits ratios, but nothing super terrible there. That doesn't seem super bad. It doesn't seem amazing, but it doesn't seem super bad either. Level of liabilities, nothing amazing there either, but nothing necessarily super bad on that front as well. So let's just come back to the asset turnover as well as the liabilities level. So let's see, they actually had been bringing down their liabilities. That might also possibly have to do somewhat with the changes in their margin levels. Possibly there was some shifts in their overall business model going on here. Maybe they were spinning off some stuff potentially. I'm not sure. Bringing down their debt levels up through when the interest rates were being raised. And then interest rates were low again. They started to maybe pick up the debt levels again, and then interest rates have then been coming back up. So maybe they're going to top out their liabilities level here. Maybe that kind of stays near an average between the peak and the trough here potentially. I don't know. Hard to say. Interest coverage. How's their interest coverage look? Trended upward and then trending downward, but this is actually still pretty good of an interest coverage level. 8 plus on interest coverage is pretty solid in my opinion. It's really like my kind of general rule of thumb. The various industries are very different, but like really I don't start thinking of interest coverage as a problem unless it's like under 6. Like that's the point where you really want to maybe take a close look at it, but it's still over 8, which is pretty solid, and it came down from 21 with the interest rate hikes. 31 to 8. So obviously interest rates had a huge impact on them, but they had a lot of leeway as far as how much interest could affect them before it was a huge problem. And then I imagine that probably did have a big impact on their valuation though. So let's take a look. Let's take a look. What we got going on there. Well, maybe not. Maybe not quite in the same way one would expect. Let's see. They've been kind of zipping around all over the place in terms of valuation over the last 10 years. On average, about a 15 to 16 between EV to EBIT and PE ratios. And then they're currently trading in the lower 20s. So they're definitely not super cheap right now. It's possible that most people see them as a potentially safe real estate option, which of course in my pricing analysis, they came out looking really good. But again, pricing analysis is not a foregone conclusion. It's really just like a note, a flag to maybe say, hey, look closer. Sometimes you look at them and they don't actually look all that cheap. It's just possibly that the fundamentals, when you take the fundamentals into account compared to the other companies you selected, they start to look cheap on that basis. But again, if it's not a very comparable group, which is maybe the case for CBRE, then potentially that doesn't actually give you that much information. So maybe the market understands that this is actually a relatively safe company relative to other real estate players, and that's why they've rebounded their valuation to twice as high as it was during the lows that it got to. But it did come down from those 20 levels. So it's basically already rebounded at the same valuation level it was at previously. But still significantly above potentially its longer term average. So maybe not the cheapest thing in the world, but it doesn't look like a bad company. That actually looks like a potentially interesting company, just maybe not that cheap. So let's see, let's get rid of that. their growth rates actually looked like historically. So yeah, we had some strong growth during the period where we had kind of different margins going on, and then the growth came down. The growth was still positive though through all of these years, only negative in 2020, and then down to low single digits in the last year or so. So definitely massively leveled off on their growth rates. Let's actually get rid of that hump of a year and kind of look at it more narrowed on the lower end of the growth rates. So yeah, maybe maybe 5 to 10% would be a pretty reasonable growth rate to expect for them. 0 to 10% to be a little bit more on the conservative end of things. But yeah, I don't know. Maybe I'll have to keep an eye on them to see if that multiple comes down, but because they definitely don't look incredibly cheap, but they also don't look necessarily like they're incredibly expensive. How has the price action been? Yeah, well, the price action has been moving up along with the valuation. So definitely seems like a lot of that multiple move, a lot of the price action has been that multiple move, but not all of it. Not all of it. Because they're not twice as expensive in price terms, right? So if they're twice as expensive in valuation terms, that means some of this price motion is ignoring and no changes in fundamentals. People are perhaps expecting their business to rebound a little bit in the midterm future. So yeah, maybe not as cheap as it looks on the list, but potentially interesting. NRG, yeah, I'm pretty sure I've looked at this one a few times before and not really been super enthusiastic about it. I'm not really very enthusiastic about utilities kind of in general. That's definitely just kind of my general opinion. Well, maybe look at this one, and then if nobody else has any other ones to call out, maybe we'll call it a day there. Energy. Integrated power company in the United States, operates through Texas, East and West segments, involved in producing, selling electricity and related products and services to approximately residential, commercial, industrial, and wholesale customers. Generates electricity using natural gas, coal, oil, solar, nuclear, battery storage. So they kind of do most of the whole gamut there. I'd be curious to know what the distributions of that is, because I definitely like some of those more than other ones. Company also provides system power, distributed generation, renewable products, backup generation, storage, and distributed solar and demand response, and energy efficiency and advisory services. So pretty typical integrated power company. Seems to do a whole lot of the whole gamut. It doesn't really give us a lot of information here to tell us like where's the distribution of their regional exposure, as well as what's the distribution of their generation exposure. I would definitely prefer to like know some of that, and I'd probably have to go digging through the filings to actually get some solid information on that. But then let's see, we got 4 to 5% for this year expected, 1 to 2% the year after that, 7 to 5% the year after that, with at least a handful of analysts on each of those. EBIT margins expected to kind of be in the mid 7s until it drops down to the 6 in the 26 range. Let's see how that actually compares with their history. Gross margins, EBIT margins. Okay, so yeah, they had kind of mid 20s gross margins, which is pretty typical for like utilities, and then it's just cratered in the last few years, which is pretty interesting. Pretty interesting. So it looks like inflation costs have hit them pretty harshly to have the gross margins drop down to less than 8% in the most recent year. And then the EBIT margins, which were pretty solid in kind of like the upper single digits, lower double digits, kind of about 10% on average, which is maybe about typical for a utility company as well, to then drop into negative territory in the most recent year after dropping into the single digits from the year before that. So pretty rough. It looks like they're just expected to rebound pretty hard in the next year. I'd be curious to see, maybe they did like an acquisition or something. Maybe they could help explain why we're seeing the stuff that we're seeing here. Let's see, return on assets. Let's pull that up. Return on assets was pretty low. Definitely not impressive. It was improving a bit there for a few years, and then it cratered down. So yeah, I don't know. I'm curious if maybe there's some acquisitions. There was some significant acquisitions in 2021, and then also in 2023. They had some smaller acquisitions going on throughout some of the other years as well. They had a big one back in 2014, but that's kind of at the start of our period here. But there was some big acquisitions, so that potentially helps explain what's going on with there, and maybe they will be able to bounce back essentially from that.
There is a huge jump up in depreciation in amortization costs. As you can see, it basically doubled from 2020 up through 2023, and that's going to be part of the EBIT margin. So, like perhaps if we were to go back to the ratios, I can see like I normally don't look at EBITDA margins. I usually like to look at EBIT margins because I like to take into account that they're going to have to do capital expenditures, and I just take depreciation and amortization as a good proxy for my capital expenditures. Depending on the industry you're looking at, that's a good or a bad or a worse assumption. So let's replace the EBIT margins with instead EBITDA margins, which will be slightly more fair to them. Now it still comes down pretty hard from the like 15 to 16, 15 to 20% on average to down to almost nothing. So there's still some interesting stuff going on there. Maybe it's some one-time charges type stuff we got going on. Maybe let's take a look. See what we got going on here. No, because they're pretty negative just in the straight up operating margin category. So what's changed here? What's changed beyond the depreciation and amortization? We did have, yeah, okay. Other operating expenses went from like 5 to 10 billion on average per year to in 2021 it jumped up to over 20 billion. So yeah, those acquisitions came with some serious operating expenses. I'm curious what the expectation is there about that, because as I showed before, the analysts seem to expect that they're going to rebound pretty good. So what's up with that? What's up with that? They were way wrong on the 22 and 23 assumptions about EBIT. They're way wrong on that front. But they still seem to expect it's going to be kind of similar in 2024 and then stay similar, but actually come down a little bit in 25, 26. So I don't know. It's like on one hand, there's some stuff about this one that looks like a potentially interesting utility play compared to some other ones, but it looks like they have potentially some serious issues to address as well as far as these costs. It's possible that if you dive into the financials, there's some solid explanations for what's going on there. Maybe these really are some really just short-term stuff that's going to work itself out, but it's definitely some questionable stuff there as well. They also seem to expect that free cash flows are going to jump up pretty hard compared to the averages that we were seeing on average here. So like boom, 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 boom. Acquisition is done here, and then they're expecting to see the cash flow from the acquisition show up here. Interesting. It might merit some close look, because that's the thing is like considering the type of industry this is in and the type of acquisitions that they clearly just took on there, it's possible that there's some really, really solid explanations for why these numbers look the way they do that makes them actually rebound the way that they seem to be expecting. But it's definitely a bit questionable on one end of it too. The 1 year returns are outstanding. Wow, look at that. More than doubled in the last year. That's pretty crazy. And then taking it back to 21, 2022, they dropped with interest rates a bit, pretty significantly, but then the acquisition levels took over, it looks like. So the market and analysts seem to think everything's fine. The market and the analysts seem to think everything is fine here, which is very interesting, very, very interesting, which also makes it seem like potentially we're just too late to the party on this one, despite the fact that they still show up as good pricing in the analysis, which, as like I said, it's like take all these pricing analysis as a grain of salt. This should not be a replacement for valuation. Valuation is a separate thing than pricing analysis, and it really only works well in your favor in my experience with it is if both of them work well for you together. So I don't know, but it's possible that maybe those future assumptions actually make sense. It's hard to say, but I don't know. We'll maybe put both of these on watch. We'll flag them with a light red, not a good color exactly, but something where maybe we'll pay attention to them, but not discount them entirely. But then, so that's just two examples right there that are basically going to do the same thing with basically all the companies in the one standard deviation list. And then I'll move on to all the ones in the first quartile list. And then we'll see what basic valuations we want to do from there. But that's essentially the plan as far as like how we use the pricing analysis. We kind of just go through, take a look at their business model. Does it seem like something potentially attractive? What does the financials look like? Does it seem like it kind of lines up with what we're expecting the pricing analysis? But is there things that maybe explain the problems with it? Take a little bit of the charts into account, but try not to overly count too much on the charts. And then maybe we do a basic valuation. And if the basic valuation looks good, maybe we build a full model for them. But that's the whole approach. So, all right. All right, guys. I think that's basically going to be it for today. I appreciate the few of you that came and chatted a little bit with me today. If you find value in the stuff that I do here, either these live streams and all the stuff that I go over, all the economic stuff I go over, or even just the valuation videos I do, it would highly be appreciated if you would consider donating to the channel. As I said at the start of the stream, the PayPal link is in the description below. Also consider joining the Patreon. The link is in the description below as well. Depending on which tier you hop into on the Patreon, you could also get access to the master dashboard as a subscription. So consider all those ways that you can support the channel. Also, leave a like, subscribe if you're not already, hit the notification bell, consider joining the free Discord. This one is free. And all right, I'll catch you guys in the next live stream, perhaps in a week or two. Or check out the second pricing analysis video that is definitely going to come out a week from today. So, all right, I'll catch you all next time. Bye.